what we're going to do today at today's webinar, thank you very much, first of all, for attending and for logging on to this presentation. Last week we did an outlook and a review of all of the major trends for the major currencies that have happened in the first quarter of 2010. Well, since we already started the second quarter of 2010 last week, we're going to talk today about what could be the outlook for the major currencies going forward in the second quarter of 2010. Now, a quick introduction for those of you who are not familiar with who I am. My name is Ilian Yotov. A lot of you perhaps know me as the creator of the quarters theory method and as one of the forex market strategists on Trading Views Network, Trading Television, Trade TV. There have been several channels there that have been switching names in the last 3 or 4 years. I'm also the founder of allthingsforex.com and tradercape.com and the host of the popular daily All Things Forex broadcast. I'm sure a lot of you listen to the program. It's a daily program, Monday through Friday, every single day, an hour of forex market analysis, trade ideas, market development, trend following, risk forex research, etc., etc. It's a great program. I suggest that you listen to it either on fx3.com or on our website, allthingsforex.com, where you'll also find the list of all the archived broadcasts from previous trading sessions. Now, in 2009, I put my quarters theory method in a book, which I called the quarters theory, the revolutionary new foreign currencies trading method. A lot of you are probably familiar with it. If you're not familiar with what the quarters theory is all about, make sure to tune into my upcoming webinar, which is coming up, I think, later on this month. And you can keep an eye on fx3.com for that event, where we're going to discuss the quarters theory. We'll do a little bit of an introduction to what the quarters theory is. And also for those of you interested in purchasing the book, you can find it on Amazon.com, or you can purchase it from our website, allthingsforex.com. So without any further introduction, let's go ahead and take a look at what the outlook for the major currencies could be in a second quarter. Now, we saw and we discussed in a program, in a webinar last week, what the first quarter of 2010 trends for the major currencies were. The main question is, will they continue in a second quarter of 2010? The bearish US dollar trend lasting for the majority of 2009 suddenly came to a halt in the first quarter of 2010, as we discussed last week. Will the US dollar maintain its strength in the second quarter of 2010? Some of the fundamental factors that we pointed to last week that have been driving the US dollar trend in the first quarter of 2010 and also going into the second quarter of 2010 have their grounds basically in the fourth quarter of 2009, when the Dubai debt crisis of late November 2009 marked the beginning of the euro, British pound, and other higher yielding currencies weakness versus the US dollar. Then we started seeing the GDP reports from the United States actually showing the US economy returning to growth in the third quarter of 2009 and growing faster than anticipated in the fourth quarter of 2009. The second quarter of 2010 is also going to give us the answer to the question, has the U.S. economy continued to grow fast in the first quarter of 2010? Now, in the next couple of weeks here in the United States and from around the world as well, we're going to pay close attention to the GDP report. Those are the main gauges of economic activity and growth in the major industrialized nations. And obviously, they can give us an idea as to what the worldwide economic recovery, what the stages of the worldwide economic recovery have been, and whether the recovery is becoming stronger in the first quarter of 2010, or whether the recovery is actually slowing down, because there have been also some concerns among economists that we could see relapse in some economists or a slower economic growth in the first quarter of 2010 compared to the fourth quarter of 2009. I think that going forward and looking into what we could anticipate in the second quarter of 2010, that could be a major factor that could affect the trend for the major currencies. Improvements in the U.S. economic data obviously more and more increase the possibilities that the Fed is going to perhaps raise interest rates later on in 2010. They have recently committed once again to keep interest rates at record low levels. But I think going into the second quarter of 2010, the big question is going to be that a lot of traders, including myself, are going to ask themselves, what exactly is the time frame for that so-called extended period that the Fed is promising to keep interest rates low? Is it a month? Is it 2 months? Is it 6 months? Is it a full year? What is the exact time frame? And if traders are able to find the answer to that question, we can see the markets beginning to price in these expectations. In a webinar last week, if you recall, we spoke about some of the interest rate futures on the Chicago Mercantile Exchange actually pointing to about 58% in recent weeks of a probability that the Fed is going to hike interest rates at least by November of 2010. We'll see whether the interest rate futures going forward are also going to show us that the market expectations are towards the Fed raising interest rates in the latter part of 2010, perhaps in the final quarter of 2010. Now that we know that the market is not going to price in this overnight before the actual interest rate hike occurs. We know that the market prices expectations for future events ahead of time. And this is what we need to prepare for as well. If the market's expectations more and more begin to reflect that the Fed may raise interest rates sooner rather than later. Later this afternoon at 2 p.m. Eastern Time, we're going to see the Fed meeting minutes. And the minutes are usually the reports from these central banks that could reveal more details as far as the monetary policies from a particular central bank, and especially future monetary policies are concerned. Was the Fed still considering and committing to the markets at their last meeting on March 16th, which the minutes are going to reveal this afternoon? Were they still committed to keeping interest rates low for extended periods? What exactly is that period, the time frame for that period? And of course, do they have did the minutes contain any hints as to interest rates being raised perhaps at the latter date? On top of that, over the holiday weekend, with Easter holiday, a lot of markets around the world were closed, including yesterday. Markets in Europe, New Zealand, Hong Kong, if I'm not mistaken, as well, were closed. Traders are returning back to their desks today, and the Greek debt drama is back on everybody's mind. Seems like we have at least swept it under the rug over the weekend. Of course, now a lot of people were thinking about trading over the holiday weekend, but it seems like in a first full trading week of the second quarter of 2010, we once again are starting things off with the Greek debt drama still heavy on investors' minds. We know that the Greek debt crisis has shaken investors' confidence in the first quarter of 2010, and it does seem to me that this is going to continue to be a factor into the second quarter of 2010 as well. Multi-year euro bullish trend versus the US dollar has threatened in the first quarter of 2010 the euro stability and integrity. It has put them in question. Will the euro weakness continue in the second quarter of 2010? And now that we're seeing today as we speak, European traders and traders in Australia, New Zealand, and Hong Kong returning to their debt, the euro weakness is still persisting. Now, we've noted, if you recall, last week, some of the trends that we've noticed throughout 2009, fourth quarter of 2009, and also the first quarter of 2010. Here we have the majority of 2009 where the euro has been strengthening against the US dollar. But as you can see, in recent months, that has not been the case. Dubai debt crisis started it all, and then of course the euro weakness continued further with the problems that we saw from Greece and potential problems in other southern European nations as well. The usual suspects there: Greece, Portugal, Spain, Italy, Ireland, and going into the second quarter of 2010, these concerns are going to stay until we get some perhaps either resolution of the crisis, which we still haven't got that. We had some proposals, of course, in the last couple of weeks after the European Union summit of an option to address the Greek debt crisis with the combined financial aid between the European Union providing 2/3 of the money for a bailout of troubled nations in the Eurozone, and then 1/3 of the financial aid being provided by the International Monetary Fund. Well, earlier this morning, for those of you who are paying attention to the latest news, the Market News International has said that Greece may want to bypass the International Monetary Fund involvement in a rescue package for Greece. Obviously, the Greek government representatives have actually declined that news from unconfirmed sources. They said that the government is not pushing in a direction to renegotiate the terms of a potential rescue package that will exclude the International Monetary Fund involvement. But it looks to me that investors, as I mentioned in a previous webinar, and discussing what has happened in the first quarter of 2010, now that we're starting the second quarter of 2010, it doesn't seem to me like investors are really convinced that the problems in Greece and potential future problems in the southern European nations are completely resolved. And it would make sense if an investor is not very convinced that things and the worst has basically passed and is behind us, that investors still sit on the sidelines and don't invest in Greek debt, or they actually request and require higher premium or higher yield in order for them to invest in Greek government debt. This obviously is putting a lot of pressure on the euro, and as we've noted in a previous webinar discussion, I showed you a strong sequence of what I call several consecutive bearish trend waves. Now, this is a weekly chart of the euro-dollar pair, and it's obvious what the direction of the trend there for the euro against the US dollar is. As you have noted here, in November of 2009, we had the euro trading at $1.5144. Since then, the euro has fallen to recent lows of $1.3267. So any kind of a euro strengthening that we have seen in the last few weeks against the US dollar has been only a price correction within the context of the larger trend, which you obviously can see what the direction of that larger trend actually is. In the last several trading sessions, I counted them, and they were about 7 consecutive trading sessions. The euro-dollar pair has been trading within a range, smaller range within a larger range or a channel. As you will see on this particular slide, this has been the small channel that the euro-dollar currency pair has been trading within in recent days. Bottom of the channel was the low at the $1.3385, and then the top of the channel was $1.3590. Now this is a smaller channel of approximately 200 pips. The larger channel was a channel of approximately 600 pips between the highs and the lows at the $1.3817 and recent lows at the $1.3267. As I've mentioned on my daily program, the All Things Forex broadcast, noting in the last 7 days that the euro-dollar pair has been trading within a channel. This is obviously channel trading, and it's basically a range-bound trading, and it's a trend-less type of an environment. We see a move to the top of the channel, then move to the bottom of the channel. Here we have the double bottom on March 25th and 26th, where intraday lows at that time were $1.23 or $1.3267 rather. bounce off of the bottom of the channel, move to the top of the channel, but now we saw in the last 7 days the euro-dollar pair stuck within an even smaller 200-pip approximately channel. So as I noted on my broadcast in the last week or so, the only way that we're going to see a more definite trend direction for the euro-dollar pair in the beginning of the second quarter of 2010 is if we actually see either a break above the top of that smaller channel, which obviously could challenge then the top of the larger channel, or a break below the bottom of that smaller channel, which could ultimately challenge the bottom at the $32.67. Well, now I'm going to switch you over to the live chart and show you the daily chart of the euro-dollar pair as it is happening today. Remember that channel and the low there at the $33.85? Here's that low that was reached 5 trading sessions ago on March 31st. It seems to me like that low was broken below today. And if you pay attention to the intraday low today for the euro-dollar pair, we already have a lower low. That is $33.56. Obviously, the news that Greece may not choose to go with the International Monetary Fund option and concerns amongst investors about the Greek debt crisis and the situation still not being resolved, and that the European Union and the International Monetary Fund financial aid plan might actually reveal in the days ahead. I think that going forward in the second quarter of 2010, this could continue to be a major factor that could continue to weigh on the euro. And in the days ahead, perhaps, especially now that we're seeing that move lower than the bottom of that smaller time channel, we're going to perhaps see the door open to the short-term low at the $32.67. That was the low from March 25th. Now, one of our attendees at the webinar is asking, do you trade with these charts? I trade with these charts. I also use other charts, but these are very simple charts that I use, and I've used them, as I mentioned the last time, for probably the last 10 years. Everything that I need for my personal trading style can be found on these charts. But of course, if you're interested in putting some more indicators like moving averages and stochastics and relative strength indices and things like that for extra confirmation, you're more than welcome to do that as well. I like to keep things very simple. The other question is your trading style to trade a break or pullback of a break, and what's your confirmation? Now, I normally do not prefer to participate in what may look like a breakout on the first attempt. And my trading style is based on my methodology, which I call the quarter series, which we're going to have that webinar. If you give me a second, I'm going to go to my notes here, and I will tell you exactly when that webinar is going to come. And that's when we're going to discuss in more detail my particular trading style. Because we're going to, at that time, I promise we'll have a full hour, because today we once again have technical difficulties. And obviously, I'm not going to have enough time to go in detail to show you exactly what I think and exactly what I do as far as trading is concerned. And I'm probably not going to be able to show you that in 1 hour time frame. We'll have to spend probably the next several months talking about it. But thank you very much for that question. The quarter theory webinar, which is going to reveal some of the styles that I use as far as trading is concerned, is going to be on April 20th, which is Tuesday. So mark the date if you're interested in finding out more as far as the quarter theory methodology. Make sure to attend the webinar, which is coming up on Tuesday, April 20th at 11 a.m. Eastern Time. That's 16 GMT, 11 a.m. Eastern on April 20th. Another question is that these charts look like moving averages, and that's exactly what they are. They're not exactly, however, a simple or exponential moving averages, because they also involve not only price changes, but also buying and selling pressure and volume. I explained in the last webinar that this particular software looks at every uptick for every particular time frame, whether it's 1 minute, 2 minutes, 10 minutes, 1 day, 1 week, 1 month. It looks like every uptick, every downtick, highs, lows, opens, highs, lows, and close for that particular time frame. And then it weighs everything against volume, and it calculates two very simple formulas, x plus y and x minus y, which are represented by the green and the red line on the chart. So they do look like moving averages. If you put slower and faster moving averages, you're going to see similar things, but the moving averages are not going to show you volume as well with that. And that's why I prefer this over just simple moving averages. Now, guys, let me continue with my presentation. Once again, if you like to find out more about the quarters theory and the methodology that I've created, make sure to tune in to the upcoming webinar on April 20th at 11 a.m. Eastern Time. So we had that move on the euro-dollar pair to the downside, and that is what we said we could see actually being one of the things that is opening the door to, hold on 1 second, sorry here. This channel right there, let me bring the camera up real quick. This channel right there, that low at the $1.3385 today, which in my opinion could open the door for a test of the bottom and a previous lows at $1.3267. Another very interesting currency that I think will be an important trend to watch is the trend with all of the yen-related currency pairs. The Japanese yen reached a new 14-year high versus the US dollar in the latter part of 2009. But we have seen at that time the US dollar quickly recovering some of its losses. And into the first quarter of 2010, and now in the beginning of the second quarter of 2010, we said that, as I was wrapping up the webinar last week, I said that could we possibly see the Japanese yen being a weak currency going into the second quarter of 2010? Some of the factors I laid down for you here on this slide, and you guys are obviously going to see that there's a lot of factors that could continue to cause the Japanese yen to be a weak currency. Now, I like to build my trades on solid underlying fundamental factors and a solid underlying fundamental edge or advantage of one currency over another currency. When we take a look at the underlying fundamentals for the Japanese yen, it is not very difficult to find a lot of factors that could continue to weigh on the Japanese yen in the second quarter of 2010. European Union Summit from March 25th reassured investors of a possible bailout plan for Greece and other Eurozone debt-ridden countries in case of default. Today we're seeing these plans and the resolution of the Greek crisis still being questioned. But eventually in the second quarter of 2010, if we get to see financial aid being provided to Greece, and a precedent being set for any other troubled nations, perhaps that could help alleviate some of investors' concerns and help with risk appetite, which could continue to perhaps cause the return of the Japanese yen carry trade. That is why I said last week, could we see a potential Japanese yen carry trade comeback in the second quarter of 2010? The Japanese fiscal year also ended last week on March 31st. Possibly decreasing the repatriation of funds back to Japan and opening the door to Japanese investors to seek higher yields, more bang for their buck outside of their own country. That could be another factor contributing to potential Japanese yen carry trade comeback in the second quarter of 2010 that could keep the Japanese yen under pressure. Consistently better U.S. economic data raises the odds of Fed rate hikes to 58% by November of 2010, according to interest rate futures trading in the week of March 22nd, 26th. Bank of Japan, I feel, is still not in a position to raise interest rates in 2010, as deflation continues to be a major issue. Bank of Japan is currently experiencing a lot of political pressure from the Ministry of Finance, and as of late, the latest news actually as of yesterday showed that last week about 100 policymakers in Japan have formed a coalition to push the Bank of Japan to become even more aggressive and more proactive to fight deflation. Some 100 legislators of the ruling Democratic Party of Japan last week have formed a group designed to urge the Bank of Japan to act more aggressively on deflation. Now, the Bank of Japan is obviously coming up. The interest rate decision is coming up tomorrow morning around midnight. They don't exactly provide us a time as to when exactly their interest rate announcement is going to hit the news wires. And it's widely anticipated that they may give a little bit more of an upbeat outlook on the economy. They may use the latest economic reports, especially the Tankan index from Japan that was released last Wednesday. It was actually very good. And it showed the sentiment amongst the Japanese manufacturing and services companies being at pre-recession levels. So that was not particularly a bad data. According to some experts, the Bank of Japan may use that positive economic data as a way to stand against that political pressure that is being mounted on them. But also, according to a lot of experts, despite of them not deciding to do more quantitative easing and give in to the political pressure, the Bank of Japan is still going to continue to fight deflation. They're not in a position to raise interest rates. And obviously, yield differentials increasing in other nations. Hence, for example, the Reserve Bank of Australia once again raising rates last night by another 25 basis points to 4.25%, raising interest rates 5 times in the last 6 consecutive monetary policy meetings. Obviously, that increases the yield differential between currencies like the Australian dollar versus the Japanese yen, and also other currencies versus the Japanese yen. So this could be one of the drivers, once again, these yield differentials, low yields in Japan, Japanese investors taking money outside, investing them elsewhere than their own country, looking for higher bang for their buck, once again could cause the resurgence of Japanese yen carry trades in the second quarter of 2010. Bank of Japan doubled the liquidity from 10 trillion to 20 trillion yen for the funds available for the 3-month loans to Japanese banks. Japanese politicians continue to call for more economic stimulus, despite of the record amount of debt and concerns over potential government fund shortages by 2012 in Japan. We don't get to hear that in the news wires a whole lot, but the problems are definitely there. According to the International Monetary Fund estimate, Japan's debt is expected to reach 218% of the gross domestic product in 2010, with the Japanese debt to GDP ratio projected to rise to 246% by 2014. Now, these are some of the negative factors that continue to weigh on the Japanese yen in the second quarter of 2010. I'm sure if we try hard, we can find a few more that we can add to that list going forward. Now, the Japanese yen the dollar against the Japanese yen currency pair has found a bottom recently at a 14-year low, which is 84.80 yen. If you tuned into the webinar last week, you have probably noticed that we have discussed that the dollar against the Japanese yen, despite of its weakening after reaching the 84.80 yen low and then bouncing higher, despite of the weakening after that, we have seen a higher low reached in March of 2010 at 88.13 yen. Since that low was reached several weeks after that, we also noted that the dollar against the yen looks poised to perhaps challenge that previous high, which was 93.97 yen. This is the 93.77 resistance, which we had maybe we didn't have enough time in the program last week to talk about that in more detail. We also noted that there was an interim resistance at 92.14, which is somewhat in the middle of this channel between the low at 88.13 and the high at 93.77 yen. 92.14 level was taken out last week, and as I mentioned at that time, that opened the door for the dollar against the yen to challenge the 93.77 resistance. And of course, if that resistance was broken, I said that the door at that point could be wide open for the dollar against the yen to challenge a very important price level for my quarters theory methodology, which would be, as I call it, the large quarter point at 95 yen. Indeed, that is what happened. Underlying negative fundamentals for the Japanese yen were obviously being priced into the exchange rate of the dollar versus the yen and also other currency majors against the Japanese yen. 93.77 resistance as of recent has been broken and the anticipated breakout has materialized. During that breakout, we have seen a strong bullish trend wave sequence on a daily chart of the dollar against the Japanese yen. Bullish trend wave number one started from around the low, which was a little bit below an important level in my quarters theory at 90 yen. Perhaps now would be a good time for me, for those of you who are new to my quarters theory methodology, to give you a little bit of an introduction. With the quarters theory, I propose that currency exchange rates do not move randomly, but rather in an organized manner, and that every significant move of currency exchange rates occurs from one large quarter point targeting another large quarter point. So these are, to me, recognizable price patterns that occur on a daily basis, and we get to see moves within these large quarters of each 1,000 pip range. What is a 1,000 pip range? The range, for example, for the dollar against the yen, between 90 and 100 yen. Those are two major whole numbers, as I also like to call them major large quarter points. They define the ranges of 1,000 pips. We have 10 yen between 90 and 100 yen. We have 10 cents between $1.30 and $1.40 if you were to look at the exchange rate between the euro and the US dollar. You have 10 cents also if you were to take a look at, let's say, for example, the pound-dollar exchange rate between $1.50 and $1.60. These major whole numbers mark the beginning and also the end of each new 1,000 pip range. In my quarters theory, I take a look at these 1,000 pip ranges and I divide them into 4 equal parts of 250 pips each. These 4 equal parts will give you the large quarters of 250 pips. So I propose with my quarters theory that currency exchange rates fluctuate within these 1,000 pip ranges by moving from one large quarter point, targeting another large quarter point. And if that large quarter point is not reached, what happens is prices could reverse back to a preceding large quarter point. Ladies and gentlemen, the beauty of the quarters theory is that the outcome of each price move is very well known and can be anticipated, and it happens in familiar ranges. Now, the range could be represented by different numbers, but the range is always the same. It is always 250 pips. And the price move always starts from a large quarter point and ends at a large quarter point. I wanted to give you the example today because this is near perfection, especially when it comes to large quarter price moves and particular trend waves, whether bullish or bearish. When it comes to the dollar against the Japanese yen currency pair, we have seen in the last couple of trading weeks a perfect combination between trend waves, bullish trend waves that complete large quarters of 250 pips each. As I was pointing earlier, previous lows a few weeks ago for the dollar against the yen were a little bit below, as I call it, overshoot below the major large quarter point at 90 yen. But as a bullish trend wave, number one, developed here in these following days, we saw prices once again moving above 90 yen. And as I proposed in my quarter theory, the next logical price move that we can anticipate to occur would be a move in a large quarter between 90 yen, potentially targeting the large quarter point at 92.50 yen. As you can see here, wave number one, bullish trend wave number one, has successfully completed that first large quarter of 250 pips between 90 and 92.50 yen. Remember, in the earlier slide, I was showing that interim resistance at 92.14 yen. Well, after the first bullish wave came to an end and a price correction followed in the next couple of trading sessions, where could we anticipate prices to pull back to? Previous support at 92.14. If you actually note, the dollar against the Japanese yen on that day, if I'm not mistaken, was March 29th or 30th. Intraday low on that day was 92.12, which was a move of 2 pips below support at 92.14. That level of support was not broken decisively, and then the correction ended. And what could we anticipate next? Another bullish trend wave after the correction has ended. The dollar yen continued to strengthen, and in the days after, we saw the second bullish wave, also perfectly coinciding with another large quarter. This time, it was the large quarter between 92.50 yen on its way to potentially target the large quarter point above at 95 yen. Now, as I also explained earlier, it is practically impossible for prices to stop exactly at a targeted large quarter point. In most instances, you're not going to see a large quarter point being reached exactly up to the pip. It would be very difficult for prices to stop exactly there. This is why in my quarter theory methodology, I have designated the rule which require prices to reach a large quarter point, for example, 95.00 yen exactly after the pip. As long as prices reach a number as a high, low, open, or close that is within 25 pips of a targeted large quarter point, then that is the range that I would consider close enough to consider a large quarter as successfully completed. If you've paid attention to what the dollar yen has done in recent days, you will know that yesterday's high for the dollar against the Japanese yen currency pair was 94.78 yen. This is a number that falls within at least 25 pips from the targeted large quarter point at 95 yen. And this is where we consider the large quarter between 92.50 yen and the large quarter point at 95 yen as successfully completed. Forward. Gentlemen, and I have some more slides and more examples of breakouts for major currencies against the Japanese yen that we discussed last week. We had a potential last week we discussed to happen. These breakouts versus the Japanese yen, but here it is, the euro against the Japanese yen was another major currency that we said could challenge a double top resistance a little bit above 125 yen. The big question was, will we see a second quarter of 2010 breakout? Indeed, that is what we saw, a break above double top resistance in the last several trading sessions. Bullish trend wave on the weekly chart of the euro against the yen is now developing, and despite of the yen's pullback on a day-to-day basis now, we will see whether that trend of euro strengthening versus the Japanese yen could resume further, especially provided to other currency that broke against the Japanese yen with the second quarter of 2010 breakout that we were anticipating. The breakout we were expecting was to happen above the 2009 resistance at 86.19 yen. This is what we've seen in recent trading sessions as well. Here it is. 86.19 resistance has been broken above, and recently the Aussie against the yen has reached numbers above 87 yen on its way to potentially challenge the large quarter point at 87. Now we're seeing the Aussie against the yen obviously pulling back a little bit after the price correction is over for the dollar against the yen, euro against the yen, Aussie against the yen. We'll find out in the days ahead if after the price correction, another bullish wave could develop on all of these majors against the yen. All right. So this is all the time I have for the webinar about BRICS, but make sure to tune in to our next webinar. It's going to 20th Eastern Time. We're going to talk about the quarter theory methodology. We'll give you an inside look at a revolutionary new foreign currencies trading method that I have created. I thank you once again, everybody, for logging on. And by the way, make sure to listen to my All Things Forex broadcast. It's a live daily program, Monday through Friday from 1 p.m. You can let allforex.com or every day on fx3.com.